Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome to the Deep Dive. Today, we are really digging into the M&A landscape for Q3 2025.
Yeah, but maybe not the headline-grabbing mega deals everyone talks about.
Exactly. We're cutting through that noise.
Yeah.
We want to focus squarely on what TMG calls the lower middle market.
Right, the LMM, specifically defense, security, critical infrastructure, and maritime sectors.
And we're using the M&A Insider Report from the McLean Group TMG as our guide, our mission. Show you where the real value is when specialization meets necessity.
And that's the key, isn't it? In these sectors, value isn't just about scale. It's about having that niche, mission-critical capability.
Stuff that's hard for the big players to build themselves.
Precisely. Technology or market access that's too difficult or just takes too long for large strategic buyers to replicate internally. And, we saw huge global volatility in Q3.
We certainly did.
But instability for the wider market. That often means high multiples for these, more nimble LMM players.
And that Q3 global context was pretty dramatic. I mean, sure, global M&A looked strong on the surface, $3.1 trillion year to date.
Yeah, up 35% over last year. Massive numbers.
But that was really skewed by, 47 deals over $10 billion?
Exactly. Meanwhile, underneath that, the economic ground felt pretty shaky. Lots of uncertainty.
We had the U.S. government shutdown starting in Q3.
Yeah.
That caused chaos.
Huge chaos. Congress couldn't pass the appropriations bills. You had, 900,000 federal workers furloughed?
Wow.
Yeah. And massive payment delays hitting government contractors. Imagine trying to do due diligence when your potential client's funding is just frozen.
Right. Impossible. And then the Fed finally cut rates in September.
First cut of 2025. Just 25 basis points, but still significant. Came alongside a cooling job market, too.
So it's this really mixed picture, isn't it? Headline growth, but underneath a lot of fundamental uncertainty.
Absolutely. And navigating that kind of volatility, especially in these specialized sectors, needs real expertise. Which brings us back to TMG.
Okay, so let's talk about the source credibility. TMG is based right there in Northern Virginia, the heart of government contracting. What makes their perspective so unique for cutting through this noise?
Well, their entire business model is built around this specialized niche. They started back in 1997.
So almost 3 decades of experience.
Right. Nearly 30 years supporting clients specifically in defense, government, intelligence. They've got over 50 professionals headquartered right there, plus other offices.
And the track record seems impressive, especially that close rate you mentioned for the LMM.
It really is. They've closed over 200 M&A deals just since 2010, and that 93% close rate between 2019 and 2025.
That's incredible in such a specialized, maybe volatile market. How do they manage that?
I think that 93% really tells the story. It speaks to the quality of their engagements, the strategic fit. See, in the LMM, buyers often aren't just haggling over pennies.
They need something specific.
Exactly. They're paying for a strategic piece they desperately need, maybe a technology or contract access. That makes these deals stickier. TMG knows this. They focus on where necessity drives the deal.
Defense, gov and intel, security, critical infrastructure, maritime.
Those core areas. And it's not just M&A advisory. They do a ton of business valuations over $350 a year.
So they're not just brokers. They're actually helping define what value is in these sectors.
That's a great way to put it. They understand the value drivers deeply.
Okay, let's dive into defense, government, and intelligence then, because those numbers you mentioned are, frankly, astounding. TMG has a custom index for defense systems.
Yeah, their own index.
And it surged 97.6% over the trailing 12 months. Just incredible.
Almost doubled in a year.
We should maybe quickly clarify TTM for everyone. Trailing 12 months. And the multiples are based on EBITDA earnings before interest, taxes, depreciation, and amortization. basically operating profit.
Right. It's a common way to look at what buyers are willing to pay relative to annual profit performance.
And Kratos, one example in that index, up 268% TTM.
Explosive performance. It really highlights the trend. And if you look at the valuation snapshot TMG provides, it underscores that specialization point.
How so?
Well, the big defense primes, they're trading around 18 times TTM EBITDA. Government contractors, maybe 12.5 times.
Okay.
But defense systems, these specialized tech providers, they're trading at 29.4 times EBITDA.
Wow. Nearly 30 times operating profit. Almost double the primes. Why? Why does that specialization command such a premium? Is the market just pricing in permanent global instability?
I think it's a mix of scarcity and necessity. The market gets that the strategic need for these specific technologies right now outweighs traditional price sensitivity.
So the performance directly reflects global tensions, things like drone warfare.
Absolutely. It's a direct reflection. Think about the heightened tensions we saw in Q3. Russian UAVs flying into Polish, Estonian airspace.
Right, those NATO border incursions.
Yeah, and the U.S. building up forces in the Caribbean, plus Ukraine really ramping up its long-range strikes against Russian infrastructure.
Using lots of drones to overwhelm defenses, right?
Exactly. Using larger numbers of drones specifically to swamp the counter-UAS systems, the CUAS, that dynamic creates an immediate, urgent need for better counter-drone tech.
Which drives spending.
Big spending. Look at the U.S. Army awarding RTX that massive contract, roughly $5 billion, for Coyote missiles and Curve-S radars.
For their LIE CUAS solution.
Correct. That kind of huge necessary investment, it validates those high valuations, that 29.4x multiple we were talking about.
Okay, that makes sense. It brings us perfectly into the actual deals happening in this lower middle market. The transactions themselves, these smaller deals don't make global headlines, but they are clearly critical.
They're absolutely critical. You have to see them as strategic bolt-ons, mostly. Large players acquiring very specific capabilities they lack.
Like Geost, acquired by Rocket Lab.
Perfect example. Geost, acquired for $253 million EV. They make electro-optical infrared EOIR sensor payloads for military satellites. Rocket Lab didn't buy a direct competitor. They bought a missing piece of the puzzle. This gives them a presence across basically all the major parts of a military satellite system instantly.
That's a huge strategic leap. And we saw a similar logic in electronic warfare and tactical comms deals.
We did. Parsons bought CTI for about $89 million. CTI brings these all-domain technologies for warfighters. It really strengthens Parsons' electronic warfare game, especially in the Indo-Pacific.
A critical region.
Hugely critical. Then you had Anduril acquiring Class. Class makes rugged hardware edge computing, tactical communications like their Voyager product line.
And Anduril wants that hardware for their software.
Exactly. Integrate Class's hardware with Anduril's Lattice software platform. The goal is a seamless end-to-end battlefield solution, hardware plus software.
But maybe the best example of how specialized contracts drive value was the Soldier Point deal.
Ah, yes. Soldier Point, already doing over $200 million a year in revenue, acquired by GovCIO.
And the strategic logic there.
Well, first, it immediately expands GovCIO's footprint at the Veterans Health Administration, the VHA. That's big. But the real prize, you could argue,
The contract.
was securing access to Soldier Point's existing IDIQ contract with the VA. It's called the Connected Care Integrated Network, or CCIN. It's a 7-year, $2 billion ceiling contract.
Okay, IDIQ. That acronym is key. Can you break down why that type of contract is so valuable to an acquirer like GovCIO?
Sure. So IDIQ stands for indefinite delivery, indefinite quantity. Think of it like a pre-approved shopping list or budget from the VA, guaranteed for 7 years.
So the money isn't all there up front, but the pathway is.
Precisely. The specific tasks, the delivery orders, get awarded over time within that structure. But the company knows it has this locked-in vehicle, this channel, to compete for and win potentially up to $2 billion in work from the VA.
Predictable, long-term federal cash flow potential.
That's exactly what strategic buyers like GovCIO are paying for. It's not just the current revenue stream. It's guaranteed access to compete for future opportunities within a defined funded program. That's huge value.
That really crystallizes the LMM value proposition. Strategic buyers paying a premium not just for tech, but for market access and these secure, high-ceiling federal contracts.
Couldn't say it better myself.
Okay, let's pivot slightly. Let's look at the civilian side, critical infrastructure and security. Similar drivers seem to be at play there.
Very similar. You're talking about fundamental needs, water and wastewater systems, energy infrastructure. The core driver isn't just expansion, it's resilience. It's mandatory upgrades and repair.
Things you just can't put off.
Right. You saw Congress introduce that bipartisan Water Infrastructure Resilience and Sustainability Act this year, proposing $100 million annually for resilience programs.
And the need is urgent, not just theoretical. That University of Idaho study.
Yeah, that was striking. Estimating that just one state needs over $1 billion right now for water and wastewater work. Why? Aging systems plus rapid population growth.
So sustained opportunity for firms that specialize in designing, fixing, maintaining these vital systems.
Absolutely. Long-term, non-discretionary spending ahead.
And turning to security, physical, and cyber federal vulnerabilities seem to be keeping M&A hot there too.
Constantly. The threats just keep coming, which drives consolidation, pushes companies towards better compliance, better protection. CISA issued an emergency directive in Q3.
About those Cisco vulnerabilities.
Yeah, active exploitation of critical flaws in Cisco ASA and firepower devices. Federal agencies were ordered to patch immediately.
And then there was that Citrix breach.
Right, a zero-day exploit there, exposed sensitive employee data, FEMA, U.S. Customs and Border Protection got hit. These high-profile failures just accelerate the demand for proactive security solutions.
Which means money flows into the companies providing those solutions. More M&A fuel.
Definitely. Look at Motorola Solutions buying Silvus Technologies for over $5 billion. That was huge.
What tech did Silvus bring?
They have this software-defined mobile ad hoc network tech, Manet. It lets units, like first responders or military, maintain high-speed connectivity even when infrastructure is damaged or the environment is complex. Critical stuff.
And cyber.
Verona Systems bought SlashNext for $150 million. SlashNext uses AI for phishing and messaging threat protection. Again, specialized tech addressing a critical, persistent risk.
The theme really holds across all these sectors. Critical risk demands specialized, often immediate solutions.
That's the bottom line.
So wrapping this deep dive into the McLean Group's Q3 report, the big takeaway seems clear. Yes, global M&A headline numbers were big, driven by large cap deals.
Right.
But the highly specialized expertise you find in defense, security, critical infrastructure, that lower middle market focus that remains incredibly resilient, highly valued.
And it's underpinned by geopolitics, by necessity, and by that non-discretionary federal spending. Like you said, you can't really defer maintenance on a missile defense system or a city's water pipes.
The need is constant.
And that necessity is forcing buyers to think and pay strategically. Which leads to an interesting thought, maybe for you, the listener, to consider.
Okay.
Given the huge contracts and these, frankly, sky-high valuations we're seeing in areas like CUAS and specialized defense systems, how is the increasing integration of autonomous technologies going to change things?
Like Kratos, partnering with GE Aerospace on the Collaborative Combat Aircraft Program, CCA.
Exactly like that. How will that push towards autonomy reshape the valuation metrics for these small to mid-sized tech companies, say, over the next couple of quarters? Is that 29.4x multiple for defense systems we talked about?
Yeah.
Is that going to be the new floor?
That's a really fascinating question. The speed of autonomy, layered onto geopolitical need, it seems like it could create entirely new benchmarks for what specialized tech is worth, makes the LMM maybe the most strategic market to watch right now.
I tend to agree. It's where a lot of the most critical innovation is happening.
Well, thank you for joining us for this deep dive into the Q3 M&A landscape, focusing on that vital lower middle market. Really appreciate the insights.
My pleasure.
We'll catch you in the next one.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.